Hello ladies and gentlemen, welcome back to Jack Fund Management. This $1.2 trillion infrastructure deal has passed. It created some winners and losers, and a microcosm of winners and losers within that. As a lot of this money got committed to electric infrastructure, blink charging will do very well. However, a sea of charging stations came about. EVgo, ticker E.G.G, likely more of a loser within this space, does not forecast FCF positivity for at least another 5 years. Although this market has a TAM, that does not really mean every business within it has a workable model. How would E.G.G honestly drive profit? Current commodity stations, fuel stations, do not have much profit. And does EVgo have any moat? Blink charging has far better prospects. Many raised estimates on 2021 and 2 rolled steel. U.S. Steel will close some furnaces for maintenance, creating a restriction on supply while demand remains. This $1 trillion plus infrastructure plan could spike demand by up to 4 million metric tons each year. Up to 60% of it gets used in products for construction. U.S. Steel looks to strengthen itself internally with sustainable steel, Verde X, and expanding EBITDA margins. As the largest producer of steel, producing 99.5 metric tons as of 5/1/21, China may lower output to work on environmental situations there. With a global market of 174.4 metric tons, this could majorly tighten. U.S. Steel, ticker X, typifies a lower multiple PE and virtually all valuative metrics. If inflation does persist, as Fed members talk about, metals have historically outperformed inflation with 75% consistency, while metals and energy trades at a discount to this overall market. Based on pattern recognition software, X has seen moves similar to this. With positive catalysts ahead, we lean more positive, as we discussed. Amongst neighbors, this run sits at a top quartile. This gives U.S. Steel upside at around 160%, with minimal probabilistic downside anytime soon. Even from our more core DCF model, X trades at about 10% under fair value, which likely offers a real margin of safety. With such a lower tenure, if investors felt more nervous about taperings, that might look very different. China with World Delta came in and fairly out of focus. Crude has rebounded in this global opening due to this passing by. And in came a horde of dip buyers rushing. Anyone who may have withdrawn any capital in a panic has done terribly, and has seen capital eaten away by inflation. Further why we giggle at these fearmongers. Peloton, ticker PTON, tanked, period. We would steer clear. They will lower prices on treads and operating margins will drop, among other things. Further investigations could pressure them on safety. Powell will extend this run this earlier cycle, pushing a more mid-cycle off to an extent. Business add-ons that businesses cannot really do without, semiconductors, CRM, and many workflow integrations look supreme here. Analog acquired Maxim Integrated, and Xilinx could get acquired next. Ticker TSCO, Tractor Supply Company, runs as a specialty shop focused on all things outdoors: livestock, equine, farm, hardware, tools, and seasonal items. With 2,005 stores functioning in 49 states, they endure about as steady as one would like in an uptrend and staying power. Founded in 1938, they have grown CFPS cash flow per share by 21.1% every year since 2004. Even outperforming in Amazon over 5 years, they have had about $600 million above net income and operating cash flow, testifying to what some declare as pure earnings. TREX company, ticker TREX, gives investors access to a probably best performing home remodeling E.S.G thesis. They have pricing power, generally a firm's markup, similar to an STLD. Ticker DRI, Darden, the world's largest full-service restaurant hub, has standout brand recognition. They have a dedicated distribution network which ensures an unremitting supply chain. They outdo every large-scale casual dining operator in gross profit, EPS, and so forth. Capitalism capitalizes on vacuums. For every mom and pop restaurant that closes, Darden can open one up and capture share, and they've done this year over year. In a big topic of share repurchasing, TSCO remains a champion. They have upped dividends by essentially 24% each year since 2010, which honestly looks like an insane number. Although this may moderate, this speaks volumes. They have a net debt of lower than 0.4 times EBITDA, a glistening balance sheet. We like giving you a clear view of every sector, of every industry. We do not just focus on fad or overcrowded trades. Of these 49 states, the 6 largest livestock yielding states, Texas, Oklahoma, Missouri, Nebraska, South Dakota, Kansas, make up a large remaining market, and TSCO, though having such a bridgehead, only has a smaller percentage in these states and a giant market to seize. Atlassian, we talked about this business way back at $120, circa 4/10/2020. Ticker TEAM will attain a $100 billion market cap. We sit at a point where big businesses focus on spend, and on those optionalities they cannot do without. TEAM, a workflow management platform, offers a subscription model which keeps charming investors, with 70% year-over-year customer cloud migration in Q4 of 2021. Throughout fiscal 21, Atlassian had more than attractive FCF margins of 39% with only hastening growth rates. Markets love sticky businesses, and Atlassian offers a visionary role. Not only this, they have a especially smooth revenue stream. Using first mover advantage, they acquired hordes of clients that would not go elsewhere with a learning curve and costs associated. An 84% versus a sector average of 49%, a standout quantity in itself. TEAM has great looking gross profit margins, a giant amongst giants. While founded in 2002, they have added 18,000 novel clients this year, a 9.5% QOQ growth rate. Six Flags, ticker SIX, possessing a business model that has gone nowhere and almost no equivalent competition based on number of parks, perched as the world's largest theme park. They have ideal locations, a decade of strong revenue growth, raking in 90% of revenues they made in this same quarter of 2019 on a 2-year stack. And people tending to like what they cannot have, outdoor fun has billowed. Six Flags consistently updates with using new technology to lower wait times, combining virtual queuing and reservations. Long parks to start in Saudi Arabia, they plan to open brands all over globally. We've had some beautiful Poisson rallies, mightily strong. We feel a bit bad for all those who withdrew money, cried wolf, and typically fear-mongered. While they probably have writhed at not capturing any of this, puckering as inflation eats and keeps eating at that capital. Maybe they realize this, maybe they do not realize this, and perhaps you will not have a negative P&L with them. We cheer if you made any money on biotech with us, Snapchat, so on and so forth, and likely many, many more to come. For that reason and many others, we really do appreciate you all for watching and taking a healthy, positive, factual, and logical look at markets. For instance, some cried red days when many, many signals pointed otherwise. S&P indices have flown above 50, 100, and 200-day moving averages. Based on these charts, not on feelings or talk, all this remains in an uptrend. All sloping upward, this looks like a bullish base case. Research from LPL looked at and stated in all historical consecutive long new high S&P 500 streaks, which we found ourselves in, odds have it showing a serious base at around 621 at 4,200. SPY is boosted above relative to bonds, opposite of any rolling over periods, as evidenced by this data. Yes, some breadth issues have occurred in NASDAQ indices, yet a lot of lower quality names, SPACs, IPOs, Matterport, ticker MTTR, had a more than understandable downdraft. NASDAQ advanced decline actually looks healthy, and NYSE ROC rate of change only looks good, bouncing off a key technical level to a major uptrend. Common new lows does not look bad. Even leveraged loans had merely a consolidation after a healthy breakout. NASDAQ 100 looks like it will retake leadership over NASDAQ Comp. A secular trend looks in effect. BioNTech got full FDA approval, which only gives more favorable tailwinds. New highs, new lows, looks like a valuable chart. Microsoft will raise prices on subscription products, a full suite. Such alterations have not occurred since 2011 and set Microsoft up for a massive jump in revenue and profits. From 1999 to 2018, if one missed these 10 best days, one gets annualized profits cut more than in half. If one missed 20 of these best days, one has a negative annualized performance, while NASDAQ UD volume has only made a higher high. Small cap indices have only consolidated. This makes small cap names cheaper. Keyword cheaper. PE multiples have actually contracted. Several higher highs and higher lows got made. Again, in keeping with repurchasing programs, Tapestry will return over $500 million to shareholders in form of share repurchasing. TPR has a global stance. Thank you all for coming back to join us. We appreciate you all for watching. Join us.